Good afternoon. My name is Joe Bloodgood. I'm a partner with Boulay Financial Advisors, and with me today is my partner Nathan Faith. Today, we wanted to talk about what we see as some really unique estate planning strategies and opportunities for 2020. Nate, how are you doing today?
Doing well, thanks, Joe.
Absolutely. Well, Nate, I mentioned earlier that we think 2020 is a unique opportunity. Um, why is that?
This year is special for a number of reasons, and the main reason is there's so much uncertainty for what the future may look like, and uncertainty breeds opportunity. So, for instance, when it comes to transferring wealth to our loved ones, uh, we actually want valuations of our assets, so what they're worth, to be low so we can transfer those assets to our kids and let them grow in their hands. We also want interest rates to be low because one of the costs of many of these strategies is what the ongoing interest rate is on using money or transferring wealth. Secondly, or third, income taxes do play a part. And presently, we're in a relatively low environment with uh, how we're taxed on our income while it's still in our hands. And then finally, what types of deductions or tax-free money can we transfer to our loved ones without having to pay taxes? Those amounts are at historically high levels, and those amounts are by law set to revert back to about half of what they are now in just over 5 years. But if there's a political shift, they could happen much sooner, which leads us to our next point.
Awesome. Yeah, it's nice to see a silver lining in what has been a challenging couple of months for folks. You know, the slide that you have up right now just gives some history of what the gift tax exemption has looked like over the years. And, you know, as you mentioned earlier, we're at historical highs, right? So for an individual currently, we're over $11 million, which makes it, you know, twice that for a married couple. But you don't have to look back very many years to see that amount greatly reduced. In 2002 it was just $1 million, and in 2009 just 3.5. So this is really an interesting look back at what these levels have been like over the years. And we talk a lot to our clients. You know, how do you what are some strategies? And I think let's start from the simple and work our way more complex. You know, number one here is just make big outright taxable gifts. And I mentioned on the last slide, the estate tax exemption is over $11.5 million per person right now. If you don't need the money, right now can be an ideal time to transfer assets or cash out of your estate. You know, those things can change. Laws are set to sunset and fall to half the amount in 2026, but political changes can make that happen even sooner. So building off of that, in the theme of transferring assets out of our estate, you know, there's a couple of other things for folks to keep in mind. On an annual basis, an individual is allowed to give up to $15,000 or $30,000 for a married couple to another individual or a family member. So if a married couple has 3 kids, they could effectively get $90,000 out of their estate by gifting each one $30,000 without the requirement of having to file a gift tax return or count against their lifetime exclusion. Another popular strategy, and I see this happen most often with grandparents, but not always, is to create almost like a little educational endowment for grandchildren or children. 529 plans are very popular for their tax benefits as a way to fund college. That $15,000 or $30,000 for a married couple we mentioned in the last point, that can be bunched up, and a married couple could give away 5 years worth of $30,000 gifts to a 529 plan, effectively putting $150,000 into an account earmarked for the college education of a loved one.
And that strategy, coupled with the next couple here, performed really well during times of market uncertainty, which provides significant discounts on valuations. And so the last strategy with 529 plans, if their investments are down, say a third or a half, and you transfer those dollars into an account like that and they rebound, you have significantly more tax-free dollars to use for your children's education or grandchildren. But what about for dollars that you don't necessarily want to specify how your family uses them outside of, say, education? That's where this next strategy comes in. So there's a method in which you can set up a number of accounts, more specifically trusts, that are called Grantor retained annuity trusts. So think of it as a paycheck back to yourself of your original investment, and any appreciation by and large goes out of your estate to your loved ones without resulting in gift or estate taxes. They're excluded. So how does something like this work? It works really well in a low valuation environment, and you can part and parcel out your existing portfolio into individual trusts that own concentrated positions. So here, for instance, assume that your portfolio owns these value positions in small companies, large companies, and companies around the world. And you set a term to this trust of a year. And a year later, you get to look to see what those accounts did, whether they grew or not. And if they grow and grow well, rebound quickly from a deep discounted time frame like we have now, you receive your original contribution back into your portfolio as your pension check to yourself. But your family, your children, your grandchildren, in their own account outside of your estate, receive practically all of the appreciation. You really don't have to know or care whether your investments go up or down significantly. If there's appreciation, by and large, that goes out of the estate to your family. And if an investment were to go down in value, you receive the dollars back just as if they'd never left your portfolio. Now, what about for folks who are both charitably inclined, but also want to transfer out much of their wealth to their children year by year over the rest of their lives? Another strategy that can be considered is essentially the same strategy we just discussed, but instead of you receiving a pension check back to yourself, your dollars that you originally contributed go out to a charitable organization. You can even name your own charitable endowment, if you will, being a donor advised fund, where you and your family still have control over the dollars, when and how they're distributed to your charitable causes. But those dollars are irrevocably destined to go to charity. So what does this look like? Again, the same methodology as with the grats, but your original contributions after the term of this trust wraps up go to your charitable donor advised fund or to a specific charity that you set up as the beneficiary, where any appreciation by and large on your investments over that term, instead of going to charity, goes out to your family, completely gift and estate tax free, effectively freezing your estate so that the appreciation is going out the door to your family. So Joe, do you want to speak to Roth conversions and how they can play a part in one's estate planning?
Thank you, Nate. Yes, let's talk for a minute about Roth conversions. Roth conversions are essentially taking dollars that you've accumulated in pre-tax accounts like 401ks and IRAs, paying the tax and converting them to Roth IRAs, which are tax-free going forward, both on growth and distributions in the future. A couple reasons why they might be more attractive in 2020 than in past years. There was some legislation passed earlier this year called the Secure Act, and the Secure Act placed new rules around inherited IRAs. So if someone passes away and leaves an IRA to anyone other than their spouse, the new rules dictate that that individual, the beneficiary, must distribute the contents of that IRA over a period of no more than 10 years. What that effectively does, particularly with larger IRAs, is force the beneficiary to take those distributions and recognize that income as ordinary income and taxable in what for many people will be some of their highest earning years and thus highest tax years. In a year like 2020, if we have a situation where certain asset prices or types of assets might be depressed in price, and couple that with maybe some economic uncertainty or a low income year for a particular individual, it can make a lot of sense to move those assets from those pre-tax accounts over to the tax-free account that is the Roth IRA, effectively getting that into a tax-free environment going forward. That's likely good for the individual who will retire someday, but it's also likely good for any individual that would inherit that account in the future. So just real briefly, we have kind of a back of the napkins type of order of operations for doing these conversions. And I think as with anything, a written plan or a manual on how you're going to act when things don't go according to plan is helpful. So we try to adhere to, if the market is down, say 10%, and you have a goal of doing Roth conversions, do about a third of it because you're getting that at that 10% discount. If we see the market go down further, say it goes down 20%, take another third, right? So you're 2/3 of the way there. And then finally, if you see the market retreat 30%, go ahead and do your entire Roth conversion target at that point in time. And then the last couple points, if we see the market continue to go down from there, this could be an area where you get more aggressive. So if you had a target to do over a specified amount of time and you hit your 1 year's worth, now maybe we want to accelerate that and do a couple years worth. And if the market continues and we see the point where the market is down by half, at that point, for many people, it's a good idea to think about converting all your pre-tax dollars over to Roth.
So transitioning to our business owners who have much of their wealth typically tied up in a closely held business that is illiquid, difficult to value in many cases, and the majority of their wealth is concentrated in that business, it can be a wonderful opportunity to transfer that business to their loved ones through the use of a tool called a family limited partnership. And it can work extremely well during uncertain economic environment like we have now. And how this can work is, let's say a family has a business that's worth $10 million. In normal times, they're allowed certain discounts because they can't easily sell that business. So it's tough to sell. They may receive a liquidity discount of, say, 10%. It may be tough to market because there aren't many buyers, so they might receive more discounts. And ultimately, they can add up to about a third of the value of the company. So you could transfer that company to your children, and from Uncle Sam's perspective, it looks like you've transferred, say, $7 million worth of wealth instead of $10 million. However, when we're in an economic environment like we are, the value of that business may naturally go down. It would normally sell for less than 10 million. Let's say it's 5 million. Not only would the value of that business go down, but the discounts would still apply. So that $10 million business that could have been sold 6 months prior may now, from Uncle Sam's perspective, look like it's only worth, say, $3 million. It's a good opportunity to transfer that ownership of the business to a family limited partnership. And as the economy recovers, as the business transitions more towards either a liquidity event or succession, then the wealth that's transferred can be realized at a much higher level than what was ultimately taxed or counted against one's lifetime gifting or estate exemption. And with that same line of thought, most everyone owns their home. And over time, the value of their home will grow with the cost of living, or in some cases faster. Yet they really don't want to have their loved ones pay taxes on the growth and appreciation in their personal assets like their home. And as long as they have the ability to continue to live in their home over the course of their lives, it really makes no difference whether someone else technically owns it. And so that's how a qualified personal residence trust can work. Effectively, say mom and dad transfer the ownership of their home into a trust, and the term may be for 10 years or so. They can continue to live in their home throughout the course of that term, and as long as they are still living when the term of that trust wraps up, the family now owns the home outside of their estate, and any appreciation is now effectively in the hands of the children. At that point, mom and dad can essentially rent from their children and now pay them a mortgage payment, which also gets even more dollars out of their hands that otherwise would be taxed when they passed on, and leverage up their gifting year by year to the family, while also transferring the wealth of their home or homes to their children at a much lower cost than what otherwise would occur. So we'll wrap up with a few other powerful but high-level strategies. So the first has to do with life insurance. Life insurance can be a very powerful tool for those who have both high income taxes and high estate taxes that apply to them. And the main reason for that is life insurance proceeds upon one's passing are income tax free by their very nature. And if structured correctly, the wealth that is inherited by their loved ones can pass out of the estate without any taxes. And that is done by having a life insurance trust be listed as the owner of the policy. The family or the parents pay premiums into that trust each year, which then supports the life insurance policy. And ultimately, a family can invest in an account that can provide significant returns on their money when taxes are considered and transfer significant wealth to the next generation. This can be especially powerful for those who have large IRAs. To Joe's point earlier, the Secure Act limited the stretch feature of retirement accounts, where IRAs could get hit quite significantly with not only estate taxes, but income taxes to heirs. So one strategy that can work quite well is to pay for life insurance premiums from distributions during life out of one's IRA to then fund a large life insurance policy so that when an individual passes away, the heirs receive an account that is completely income and tax free versus receiving an account that is hit doubly hard with both income and estate taxes. Another powerful strategy has to do with where we live. So, Joe, do you want to speak to how that can impact our taxes?
Thanks, Nate. So one option, like you mentioned, is to actually pick up and move. If you're a resident of the state of Minnesota, you know certainly that Minnesota has a fairly significant state income tax as well as a state tax. And so there are a couple states that we see a lot of times our clients will actually choose to pick up stakes and actually move for purposes of avoiding these. And so Common states like Arizona and Florida are popular for folks for not only their sunny weather, but their more favorable tax law.
So finally, we'll wrap up with how charitable gifting strategies can be powerful estate transfer strategies. So lifetime charitable gifting strategies sometimes can result in tax savings that are almost as much as the actual dollars that are gifted to charity. The term for that is arbitrage, essentially risk-free transfers without any real loss of money. And how that can work is for folks who have both high income taxes as well as high future estate taxes, they can get double the benefit. So in certain cases, folks can gift not only cash, but they could also gift appreciated securities, avoid taxes on the gain, and also receive the full tax deduction. And the circular calculation can work out where folks save 60 to nearly 90% of their contribution in taxes that year. And by gifting money to charity, those folks reduce the size of their wealth, which then reduces the eventual tax on that wealth and ultimately can provide significant dollars to the family's favored charitable organizations without really changing how much is transferred in the end to their loved ones.
Thanks, Nate. That was great. It seems clear that 2020 could present some unique estate planning opportunities for folks out there. That being said, these ideas should be tailored to your personal situation. So if you have any questions or we can help you more directly, please reach out. We can incorporate our estate planning team and work with you to determine if any of these opportunities would be good for you and your family.